Welcome everybody to today's Investment Committee meeting, Wednesday 24th of May. Welcome to members of the committee, to councillors as observers, and to Jeff and staff from Kelly, and also to Jonathan from Ericsson Global. If we could open the meeting please with a karakia timatanga, Councillor Newman.
Mai te paimanga raro ki te tai, mai te awatonga raro ki te awaraki, tēnei te hapori awhi ai taratahi, whanau, hare mai te toki, homie huie tai ki e.
Thank you, Councillor. Apologies. We have an apology from His Worship. Somebody like to move the apologies, please? Councillor Newman, seconded Councillor Lawrence. Thank you. All those in favour? Aye, carried. Conflicts of interest declaration. Anybody like to declare a conflict of any agenda item? If not, there's no public forum, so we will get straight into the agenda proper. And we start with 5.1, the minutes of the meeting held 22nd of February. Somebody like to move those? I'm happy to move that they be received. Seconded by Councillor Lawrence. Thank you. All those in favour? Against? Carried. Any matters arising that it won't be covered? Thank you. Okay, first report 6.1, investment update report.
Thank you. So this report provides an update against Council's investments since the last committee meeting. You will see we have quite a healthy bank balance, and the report also recommends that Council proceed with investing a further $2 million, the committee and Council proceed with investing a further $2 million previously approved by Council for managed funds. So we have, as attachments, we have our schedule to show the position of our investments, as well as a report from Jonathan from Ericsson Global, and the first one being an update on our current investments, and then the second report being the recommendations should Council or the committee endorse the approach to continue with the further investment where we would invest those funds. I'm happy to take questions, or I don't know if you want to get Jonathan to comment first.
Yeah, Jonathan, have you got any comments to make, please?
Well, yes, in the sense that I'm taking the papers as read, but it is a really interesting environment as far as the financial markets go. And in that sense, there are two issues which we don't think should affect the decision, but I'd like to talk to, if that's appropriate. The first is the fact that this afternoon, the Governor of the Reserve Bank is going to make a pronouncement on the cash rate. And it's likely that the cash rate will go up a little. It may go up a little bit more, but it's not necessarily going to go up at all. And there isn't actually any point, in our humble opinion, thinking about what's going to happen, because the cash rate's at 5.25%. Whether it goes up to 5.5%, or 5.75% doesn't really change the markets or the way your managers to date are managing the money, nor, if you accept our recommendations, how Milford manages the funds. For what it's worth, and this is a personal view, not a house view, I think it's going to go up by 25 basis points. And that's simply because in the last month or two, the Federal Reserve has raised its cash rate by 25 basis points. The Bank of England has raised its cash rate by 25 basis points. The European Union has raised its cash rate by 25 basis points. And the RBA has raised its cash rate by 25 basis points. In other words, it's what everybody else is doing. Now, because it does have an impact on mortgage rates, it may impact short-term rates a little bit. But the key point is that long-term interest rates in New Zealand are still relatively low. Our cash rate is at 5.25. The 10-year government bond yield is at 4.5. And in the good old days, which some of you grey-haired, bearded people will remember, and not necessarily bearded either, you know, the cash rate used to be 4.5%. and New Zealand government bond yields were around about 6%. So, and you know, 4.5 is I think still a bit low for long-term bond yields. Now, in that sense, you'll be interested to know that Milford has a very conservative view of the markets, as we do, and they're already pricing in an increase to long-term bond yields and hedging those positions. So that's that. The other issue is the equity markets in particular are a bit volatile in the US at the moment, because the Republicans, having gained a Congress majority, are playing games with the debt ceiling yet again, and they are not agreeing to increase the debt ceiling, which is already big, but they need to go higher in order to pay their debts. Now, this is something that's been going on for several years. It happens every year. And at the moment, it's causing more issues for the media and the markets than, again, it should. Because if the US couldn't pay its bills and didn't pay its bills, then the whole world's financial system would collapse. In fact, the Bank of Japan is still printing money and still has negative cash rates, but at the moment, the Federal Reserve's cash rate is 5.25%, exactly the same as New Zealand's. And they're the two that are at the top of the pops. But unlike New Zealand's 10-year bond rate, the US 10-year bond rate today is 3.7%. So it's even lower than ours. So in that sense, the bond markets aren't actually pricing in a default of the US dollar or the currency or paying their bills. And in fact, it was quite strange in a sense. The US market, equity market, went down overnight because of concerns that the discussions between Congressman McCarthy on the Republican side and President Biden didn't come to any conclusion. But at the same time, the US 10-year bond yield went down and the US dollar strengthened. Now, the reason I'm saying all this, I'm not trying to confuse anybody. I'm trying to paint a picture of where the markets are at. And I hope this will encourage people to ask questions if they have any. But the point is that if a country was about to default on its debt, like, say, for example, Argentina has done several times in the past, then surely its dollar would weaken and the bond yields would go up. In other words, the bonds would be sold off. And the opposite is happening as far as the market's concerned. Now, I'm saying all this just to try and reassure you that your strategic plan, which you're following at the moment, to invest $5 million in managed funds, is absolutely on track, despite all the noise in the media. And we recommend today that you proceed along the lines that we've suggested. And in that sense, if we look at what's happened to the 31st of March, two of your products have made money and one product has lost money in unrealized dollar terms. It hasn't actually lost any money. You've actually got a good 2% or turn a bit percent distribution from it, but it's got some unrealized losses from a couple of the underlying businesses. And I'm talking about the Castle Rock product. Now, that is a private equity product where effectively you do get more volatility because the underlying businesses are only valued quarterly, and you don't have a market to price them against on a daily basis. But we submit that that's a good thing because there's a lot of noise in the markets, as I've tried to explain. So in that sense, what we're recommending is the extra 2 million be invested in the two more defensive income fund products, plus a big chunk in a third income fund product, which, like the other two, are our most confident and best predictors for generating stable returns and protecting capital going forwards, which is what you want. There's no point in getting a high return if you take so much risk that you actually lose your capital in that. But these products have been around a long time. In fact, the Milford Income Fund that we're recommending was designed straight after the beginning of the global financial crisis in 2007, 2008. And it is very defensively managed. Now, I say that, but I don't want to scare you, but we get very thorough quarterly briefings on all these products because they're ones that we believe help and suit our clients collectively. And you may recall that Credit Suisse, which was a big Swiss bank, ran into problems after Signature Valley Bank went bust through a very poor governance issue. But anyway, Credit Suisse went down, and before the Saudi Arabian fund pulled the pin on putting more capital into Credit Suisse, Milford, this income fund, which had invested a little bit in the AT1 bonds of Credit Suisse, actually got them out. They got them out the day before the Saudis stopped funding Credit Suisse. Now, I say that because it demonstrates three things. The first one is that this product is actively managed, that they do take some risks, but then they manage those risks very tightly and act quickly. And those are the sorts of things which we believe you need to know at this point. There's one more point about Milford, and that is that recently, well, in February, in fact, the chief executive, Mark Ryland, announced that he was stepping down in March next year. A week or so ago, following a change of chairman of Milford, he changed his mind and said he was staying for the foreseeable future. Now, we knew Mark Ryland when he was chief executive of another boutique fund manager, Brook Asset Management, and we know he's a very safe pair of hands, and we rate him highly. And we rate the Milford team very highly, both on the investment side and the governance side. But we're actually encouraged because Gavin Walker, who was the chair, has stepped down, and he's better at managing big funds like the New Zealand Super Fund and things like that, or being involved in those. The corporate culture and the people culture at Milford is a boutique, and they nurture their people very well. And the new chair is Anthony Quirk, who you may recall was one of the four founders of Milford when it started a decade or so ago. So, well, 15 years ago, actually. So in that sense, as I say, we regard the changes that have occurred and the fact that they were kind enough to tell us in advance of the public announcements that Mark Ryland was stepping down, and then also told us in advance the announcements that he's not stepping down. We can assure you that as part of our service to you and all our other clients, fund managers in general are quite communicative with us. They tell us about the mistakes they make as well as the risks they take, and we kick the tires with them on a regular basis. So I have absolutely no qualms in saying that if you take these recommendations that we've made, which are supported by management, then I don't believe it'll mean that you lie awake at nights worrying about the decisions you've made. So I hope that's helpful, but very happy to take as many detailed or demanding questions as you have.
Thanks, Jonathan. I suppose from me, a comment and a question. And I talked to Kelly about this before. What I would like to see is almost like an executive summary in this document that actually explicitly gives us the information on just how our investments are tracking. I mean, the reality is we invested $3 million 6 months ago and we've lost $9,000 in the 6 months, which suggests to me that it's not a great investment because we're losing money. Now, I appreciate all the comments you've made in the document about it's too early to say and I take on board all of that, but our report, our staff report and your report, nowhere does it say this is the actual result to date on this day of that investment. You can read stuff and you can put stuff together, but I want to see, in the terms of the investment committee, I want to see it explicitly summarised, that just where it's sitting. And I suppose the question that follows on from that is, notwithstanding anything you've just said, at what point do you, as our advisor, convey to management that, you know what, this is not tracking the way you want, and it's time to, because I mean, we're meeting every 6 months. If in 6 months' time we get another report and we've lost another 10,000, you know what I mean? I'm reliant on your advice as the person at the coalface to give us, not just wait for a meeting, but give us timely advice as, you know what, we need to reevaluate this stuff now to try and keep us ahead of the market, because on paper, we're not heading in the direction we were expecting to 6 months ago. So I just put that on the table.
Could I?
Yes, thank you.
Jonathan, it's Jeff here. Kia ora. I think I remind the investment committee of our strategy, our investment strategy, which was to create a long-term fund. And as part of doing that, a long-term fund will have swings and roundabouts in its fund returns and its earnings over time. But the strategy was never to try and beat the market or pick the right time to invest. As you may recall, the strategy was to invest a little bit every now and then so that you're always in the market and you're investing in the market rather than trying to beat the market. And I guess that would probably lead me back to a question that I'll hand over to Jonathan to answer, which is, so we've got a recommendation in front of us to invest the second $2 million. And if I could probably summarise what Dale is suggesting. So we've lost money on the first 6 months. Why would we go again? And that's probably the question that's on everyone's mind. Would that be a fair assessment? Maybe, maybe not. No, maybe not. Okay. But so from my perspective, I think I just wanted to remind the committee that we are looking to build a long-term fund, and that long-term fund has to have regular updates, as we do with our KiwiSaver, as we do with our own savings. We regularly drop money into our KiwiSaver, despite the fact that it goes up and down over time. We still contribute to growing the capital of that investment, and over time, knowing that will even out and generate a positive income and a positive return. So I'd also like to just reiterate that the investment strategy was around an income fund. We weren't necessarily looking at a high growth asset. So as a result, the recommendation is for Milford Income Fund. So it's not a growth fund. And that will be slightly more conservative and probably have a heavier weighting of bond in it rather than a higher weighting of equities. And that bond will smooth out the returns, but provide a consistent income return over time. And as Jonathan pointed out, as those bond yields decline, there is a capital gain that occurs. So it's the inverse of shares. There is a capital gain when bond yields decline, and you've bought it at an amount, and then you can sell at a lower yield, which results in a capital gain. But that's not the reason we're doing this. The reason we're doing this is around a long-term investment, a diversified range of partners that we are investing in, and that leads to a diversified risk. As we found, two of them have gone okay, one of them has pulled back a bit, and as a consequence, we are where we are, as the chair pointed out.
Councillor Lawrence, Councillor Newman, members of the committee, comments?
Well, I'm quite encouraged by the recommendation on the basis that the fund that has cost us some money is the one that Ericsson's are recommending or not recommending any further money in. I was a little bit surprised when I came on the committee to know that we had in fact invested in horse floats and hairdressing salons.
And Hell Pizza.
And Hell Pizza. I'm not sure that all of the ratepayers would be that excited if they bothered to read the minutes to know that. So I clearly don't want to sell out of it because, they're relatively small businesses and I know a little bit about them. And it's a little bit of a challenging environment for the last 3 or 4 years. And I imagine over the investment horizon that we're looking at, that'll be fine. But certainly wouldn't advocate any more money in there. I know a little bit about Milford over the years. They've been extraordinarily successful. So I've got no problems with the recommendation.
Thank you. Councillor Newman?
Yeah, I'm the same. I'm not really worried about what's happened so far. Personally, I just do it and then don't look at it for ages. Is the easiest way to do it, because if you keep looking, you're going to be more and more worried about it. But I know we have to have visibility over it. But personally, that's my strategy, is just ignore it. So no, I'm comfortable. It's going to go up, it's going to go down. That's a risk of investing how we've invested. And I'm happy to support the new investment.
Councillors, as observers, you don't get a vote, but you're welcome to comment. Any?
I just had, thanks, Chair. I just had one question. I remember this came to council meeting. Was it put in front of us just as informative, or did council endorse your endorsement on this?
Council endorsed the creation of an investment committee and the first $5 million worth of investment into the funds. And so that council has already proposed and recommended and adopted that recommendation for $5 million worth of investment. The first tranche didn't invest $5 million, we only put in 3. And we decided that they would delay the second $2 million worth of investment until later on. We had potentially independent chair for this investment committee. So we've gone through that independent chair process and found that the market was a bit thin. So we've got Dale running point. And
Good stuff, Dale. Well done.
Massive endorsement there, you know. We couldn't get anybody else, so we got him.
Apologies. We ran the independent chair for the investment committee and the audit and risk at the same time, and we found that we only had one applicant for the independent chair for the investment committee, and we didn't feel that that was appropriate to then use that as the basis for selection. So we said we'd rerun this later on once the investment committee was stood up and had a bit of a track record, because that was highly likely one of the reasons why we didn't get a whole lot of people interested in it. So firstly, set up the committee, create the structure, do the first tranche of investment, and then bring the second $2 million back to the committee once we'd had a little bit of time at the plate, and that's what we're doing now. So does that
Yeah,
answer
so
a little?
kind of, it was more around the three companies chosen to invest in. I just can't remember how the
Council didn't, that was this committee's
Yeah.
responsibility.
And that's what how it was written in to council. I was just thinking, was it put to council? Yes, we're investing $3 million in these three companies. Is the next $2 million getting invested in the same three companies? Is how?
Yeah, perhaps I could clarify. The first $3 million tranche was put to council because that recommendation was required in order to create these funds. Following that, the terms of reference for this investment committee was adopted, and that's been delegated to this committee. So all new investments will then be the responsibility of this committee. But the first three, because they were an adoption of council to invest in and create the committee, they were run through council.
Great. Thank you.
It's our responsibility to put it in the right place with expert advice and support from our team. Steve, Brian, have you got anything?
I just like to reinforce the decisions that have been made. I think we've got some really good advice coming from Ericsson's, and I think, I think we've got to follow it. As we said right at the start, it's not short-term investment, it's long-term. So I think we've got to let it pan out. So that's me.
Thank you. Kelly, have you got anything to add? Anything?
I suppose picking up on your request earlier, be happy to add something into the report, the start of my report, to show the original investment value and then the current position of the investments, and probably also useful any distributions as well, because they don't show up in the balances, but of course that's an additional benefit of those investments as well.
Yeah, I'm just sort of conscious because this is a new step for council. I don't want anybody reading this to think that the things are being, hidden in the murk of graphs and things like that. I would like to see quite explicit so that people can go straight to it and make their own conclusions. We still have the responsibility to make the decisions and stand by them, but it just would be good, I think, to have an executive summary on that.
Yeah.
We can do that.
Yes.
Can I ask a question? You mentioned before, at what point do you kind of cut your losses and sell out of it?
Yeah.
Is that a conversation that we should have before we get to that point? Like, where do we feel comfortable?
What
Well, let me answer Dale's
that's where we
question,
rely
since he's
on
the chair of the investment committee. We are proactive, and in that sense, we have a weekly investment committee meeting. Funnily enough, on a Wednesday at 11 a.m, and I had to leave that investment committee meeting to come and present to you, which I'm very happy to do, of course. But at those meetings, we discuss managers, both ones we want to review and consider hiring, and ones we want to review and consider firing. And so that is our internal decision-making point. But we only have one rule with clients, and that is that the customer's always right. So sometimes we recommend people fire a manager, and we did that quite recently with a firm called Key Street, which was an active boutique manager. It actually came out of, it was the senior staff of Brook Asset Management that Mark Ryland used to run, but he wasn't involved. He went to Milford. But the other senior people set up Key Street, funded by Craig's. But then Craig's decided to sell it to Smart Shares, which is a subsidiary of the NZX, and it's a passive manager. And so you've got active managers going to a passive shop. But more importantly, the two key people who were ex-Brook Asset Management and then Key Street, they both decided not to accept Smart Shares' offer of employment, but to leave. So we promptly went around all our clients and recommended they exit. And that happened shortly after I had a meeting with those two particular gentlemen and asked them, are they staying or going? Now, another example, there was a firm called AMP Capital that you may have heard of, because they used to run a lot of money in Australia and New Zealand. They don't actually exist in New Zealand now. But when the chief executive in Australia was appointed, but was someone who didn't actually behave properly at staff Christmas parties and got into a spot of bother. When that happened and the morale of the New Zealand AMP Capital team was damaged, we actually took all our clients out of all the AMP Capital products and put them into other managers. So those are just two examples. One of them, Quay Street's a very small manager that you may not have heard of. I know you've heard of AMP, and thus you should have heard of AMP Capital. But this is the point about us. We actually kick tires for a living. And Dale, I told you you don't have to worry about sleeping at nights. I've actually been lying awake a little bit recently because we think that the markets are still a bit top heavy, even though there's been significant corrections last year. But that's why we're recommending going into a low risk income fund, as Jeff said, rather than putting more into growth funds at this stage. The other point is that with Castle Rock, they've got 5 businesses now. They're also, I don't know if you know, but they're the chief pet supplier, especially of tropical fish, to Animates and the Auckland Zoo. And that business is still going well. The hairdressing salon is not. And for a very simple reason. You may remember the government doubled the amount of sick leave that staff can get. Well, during COVID and with kids having coughs and colds and stuff, a lot of the staff at Vivo are actually taking that sick leave. And so they haven't got enough hairdressers to cut people's hair or do the styling and things like that. But they're working on that. And in that sense, yes, your first 6 months had a negative unrealized loss in Castle Rock. We'd strongly recommend you don't sell that. You can sell it every quarter if you want to, but that is one where it's a very long-term investment. And effectively what we're investing in it or recommended it to you for is the 2% per quarter income distributions, which Kelly referred to. And the point is you still got your 2% distribution at the end of March, even though the capital value went down a little bit because of the 2 of the businesses out of the 5, not Majestic Horse Floats, actually, that was doing very well. The other one is Hell's Pizza that was struggling a bit for the same issues around COVID and staffing. But the Hell's Pizza business itself, the franchises, are actually doing well and growing. It's part of the general uncertainty of the New Zealand economy at the moment, not the value of those businesses. In that sense, you could say that Castle Rock's a little bit like your house value, which could well have gone down because interest rates have gone up recently. Now, I hope they haven't, because I know Carterton's a very desirable place to live. And I personally like
up.
He's sucking up now, John.
No, I'm not. I'm honest, because Peter and I actually went to visit another client in Masterton recently, and we drove through it. And it's chalk and cheese. But anyway, moving right along, I'm very happy to answer any other questions, but I actually do commend these investments to you, and I know you're on the right track at this point. Now, there will be more volatility going forward, because the key thing I haven't mentioned is, of course, there's a general election here in October, and that could well make another difference to how things go. But in that sense, we have a very good relationship with Jeff and Kelly in particular. And if necessary, if Peter Verhart and I and the rest of our team here think that you're in the wrong thing, we'll tell you as quickly as we can. So you don't have to worry about that, Dale.
No, that's fine. I guess, given that this is a new direction for council and I'm the chair, albeit interim, until someone better comes along, you know, I take the view that this is my own money and I want to make sure that we are making the right decisions, or at least asking the right questions of our expertise to reassure us that, you know, we are taking every step to not just protect our investments, but also manage our ratepayers' interests. So now, look, I appreciate everything you've said, and I appreciate the recommendation, the support from Kelly and Jeff, and also appreciate the committee and the other councillors in the room who are all learned people in their own right, and they've given their comments on this. So if there's nothing further,
Well, can I just ask about distributions? Are they reinvested or do we get them in cash?
They're reinvested, I think. Yeah. Sorry, I'm trying to remember if we decided to reinvest all of it or half of it. I'll just have to check that.
Might be half.
Yeah, I have a feeling it's half.
I think
half, Jonathan?
Yeah, I think it's half, but I'm a little hazy on that too, because it happened 6 months ago.
Yeah, I can check that. Steve.
What is your preference? What do you have a particular view on that?
Well, not really. It just makes a difference to our, as Jonathan said, it makes a difference to our outcome.
Yeah.
If the capital value of Castle Rock has gone down X, but we've got
Sure.
Y in the bank, then it should be X minus Y as to what we've actually lost.
We'll put a clear summary on the next report for the committee.
Showing that.
For that, yeah.
Distributions as well as capital values. Yep.
Yeah. The other thing I'd just like to say in answer to Lou's question was, I don't think we should be setting a benchmark at which we want to bail out of things, because we haven't got the faintest idea. We have to rely on Ericsson's who know about, you know, who's had lunch with who and what's likely to happen, whereas we'd just be panicking and crystallising losses all over the place, and that gets.
No, look, I agree, Steve. The reassurance I was seeking, and I've got it from Jonathan, or we've got it, is that they are all over this constantly, and they would be advising us in real time rather than waiting for us to prompt a conversation or the next meeting. So I appreciate that. That's the reassurance I was seeking.
And not looking at it just once every 6 months.
Correct.
Because
We're purchasing the advice based around expertise. So thank you. Okay, we've got recommendations on page 12. There's 3 recommendations. One, that we receive the report. Can I have a mover and a seconder for that? Councillor Newman, Councillor Lawrence, thank you. All those in favour? Thanks, carried. Second, notes the resolution of council on 1/4 September 2022 that a further $2 million will be invested in long-term investment funds by 30 June 2023. Can I have a mover of that, please?
I'll move that.
Councillor Lawrence, Councillor Newman, all those in favour? Against, carried. And 3, endorses the decision to invest a further $2 million in long-term investment funds. The allocation as follows in those 3 subsets: Castle Point 325, Harbour Income 325, and Milford Diversified Income 1.350. Everybody happy with that? I'm happy to move that. Do I have a seconder? Councillor Newman. All those in favour? Against? Carried. Thanks, Jonathan. Thank you, Kelly and team. For all of
Pleasure.
that. And Kyra.
Thank you, Jonathan.
Okay,
Very good.